Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Lovely week. Seen stocks actually been pretty calm over the past few weeks. Not much movement up, not much movement down, so that's a good thing. And we're getting to that time of year now where the market, if it's going to put a big move in, it's historically, it's been the time that it happens. Although I wouldn't count on that. I can remember a couple of years ago where the December was just horrible. It was down, I don't know, 15 or 20% or so from peak to trough. And so that happens. It's not a big deal. But, I want to say thanks for everybody that came out to the seminar this week. I had a very good crowd, very nice people, very good questions that they had. And I think we're kind of talking about some of the changes that have occurred. One big change that's occurred is a type of a variable annuity. It's new. It's very low cost. You have the option to add riders, so you can actually control your costs by controlling the level of guarantees that you want with the product. I think it's a great idea, just a phenomenal idea. If you don't want the guarantees, it's going to be incredibly difficult to invest directly in those products at as low of an expense ratio as you can through these products, which is highly unusual for a variable annuity. So I would, if you'd like to talk more about that, please feel free to give us a call. In fact, we're going to start a service. We have been offering it for about a week now, where if you have older annuities that are out there, you may want to take a look at it. You're not always stuck in the annuity. Oftentimes, you can do something that's called a 1035 exchange, and that allows you to exchange one annuity contract for another contract. And if you can do it without fees or penalties, that's a great thing. There are no fees or penalties for moving in and out of the products that I'm using. There's no sales charge, and there's no penalty if you take the money out before any given time period. So you could have it in there for 1 week and take the money back out, and you wouldn't be charged a penalty for that. And that makes it very different. The expense ratios, you have a lot more control over them by electing which kinds of benefits that you'd like to have. I think it's an awesome thing. If you don't want it, don't include it. Don't have a one-size-fits-all mentality, because that is typically not the best thing for every individual. Everybody's different. I mean, people have different situations. They've got different family situations, financial situations. You really would need as many options as you can possibly have. So if you have some older contracts out there, this one is worth taking a look at. You might want to give a comparison. And we do that for free. So if you're thinking about making changes, if you're looking at your products and wondering if you might be doing better elsewhere, and by the way, we're obligated to tell you if you have a product that's a really good product and it doesn't make sense to move, then I'm going to tell you that. Because you know what? At the end of the day, I have to sleep at night. That's what it comes down to. And I'll tell you like it is. And I've seen some pretty good products, especially some of the older products that were purchased a long time ago that are still around before the expense ratio started getting super, super high. There's a lot of older products out there that I'm talking 15 years ago. If you still have one of those, oftentimes, the advice is just stay there. That you're good. But if you've purchased something within the last 15 years, there's a pretty good chance that we could either save you money, and we could save you money, and then give you more options too. So again, feel free to call us. You can go to my website, bullingtoncapital.com, if you want to contact me there. I was just laughing at the seminar, because a lot of people are going to the website and they're filling out the contact form, but they're not putting anything in the comments. So I have no idea why I'm calling. And if you could just remember that would be good. Just so I could be a little bit prepared. I mean, I don't mind calling or emailing and asking you what kind of question you had. It just helps a little bit if I know what you're thinking of. So that's bullingtoncapital.com. There's no fee for any of this. You can talk. We're more than happy to talk to you as quickly as we can and try to answer any questions that you have. So again, we were talking about the new development. And incidentally, this morning, I got up. I check all the time. This morning I got up, and somebody, another one of the variable annuity companies out there, is already coming up with a product that's fairly similar to the Nationwide. I knew that was going to happen. But this is the first shot in a new direction, and it'll be interesting to see now the heat is on, and they're all going to have to try to compete. And one of the things you want to be real careful of when you're looking at variable annuities, see, a variable annuity means that it has mutual funds in it, so the insurance company doesn't actually have your money. They're administering the contract. The money's with whatever firm, Fidelity or Vanguard or T. Rowe Price, whichever of the mutual funds that are inside that variable annuity, that's where the money's being kept. They're just keeping track of it. And if you need to disperse funds, they will handle that. Those funds, because firms like Nationwide handle so much money, have much lower expense ratios than the typical fund that you would buy just walking into a Fidelity or a brokerage firm and buying them. So there are a lot of differences. I think one of the great things is expenses can be a lot lower on these products. They're very tax efficient. One of the big reasons that a lot of people might want to look into these, if you are above the age of 70 and you're being forced to take out required minimum distributions, and you have regular investment accounts, if you were to convert those regular investment accounts into investment-only annuities, which is basically what we're talking about, they're investment-only, then you don't get a 1099 anymore, and you could defer whatever dividends and capital gains are being distributed from taxes because you're having to take out money from your RMD and pay taxes on that too. So there are a lot of planning options available with this sort of thing. And there are a lot more guarantees. It's hard to say guarantee when you're talking about stocks. If you're talking about a stock fund, there are no guarantees. It's whatever the fund makes, which is fine as long as you know that. That's how I feel about everything. As long as you're fully informed, then most people can make pretty good decisions. Oftentimes, most people don't know what all their options are, and I think that's a kind of a big deal, trying to figure out what you can actually do with your money, what kind of problems you're having, or what kind of problems you think you might have, and what would be your viable options to help solve those problems. So that's the kind of stuff we do on a daily basis at my firm, and are much more than willing to talk to anybody that has issues or questions about that. In fact, I'm actually pre-recording this show. Most of my shows you could actually call in and ask those questions. So I typically pre-record maybe one a month or so. So you can also call and ask during a radio show, during a normal live radio show. And I'm just losing track of my whole timeline here. One of the other things that we talked about last night, the Look Out for the Bull website, that's up. It's actually operational now. I think it's going to be pretty fun. If you're curious about it, just go to lookoutforthebull.com. I've had people going to Bullington Capital looking for Look Out for the Bull, and those are actually two different services. The Bullington Capital is for the investment planning and advisory services that my firm offers. Look Out for the Bull is for the do-it-yourselfers who want to learn how to be momentum investors. I like the idea of momentum investing. It's not as easy as you might think it is, and I'm very forthright about the challenges that you face, but value investing is no cakewalk either. value investing is the opposite approach, where you're trying to buy low, sell high. That's really tough to do. It's tough to do well. When you look at a company like General Electric, for years, that stock just climbed. You look at that stock in the early 90s, all the way there was like a 10-year period there where it just did no wrong. And it peaked out at the highest price that it's traded at was actually $58.41. And that was in August of the year 2000. So in the year August of 2000, it's $58.41. And today it's $11.60. Now, what year is it again? It's 2019. And, it's just so heartbreaking to see that. It's one of the reasons I'm not a big fan of value-oriented investing, that buy and hold. Hardly anybody does that anymore. And there are lots of good reasons that they don't. It's just incredibly difficult. People like to point out Warren Buffett. Well, he buys and holds. Warren Buffett buys and holds the entire business, the whole thing, which means he gets to keep the profits. As a shareholder, you don't have those rights. He's got a big edge over you, over all of us, actually. And so it's not very helpful to compare yourself to something like a Berkshire Hathaway. Their business is buying other businesses and keeping the cash. That's their business. They're pretty good at it. They're very good at it. In fact, you could argue that that's like buying a fund, because I think they own over 80 companies now. It is really, really big, and it's a lot harder to manage when it gets that big. And it's had its time periods where it was down a lot too. And anyway, I digress. I'm looking at something. Just give me a second here. Yeah, 1998. Even the Berkshire Hathaway, which is selling for $326,000 today per share. $326,000 per share. That's amazing. Anyway, it was selling at $84,000 a share in 1998, and in 2009 got down to $70,000. So 1998 to 2009, and it shows a negative return. That's 11 years. So when they talk about long-term investing, which Warren Buffett's talking about all the time, that's long-term. That's 11 years and you're negative. And he doesn't like to pay dividends. So that's one of the problems that I have with value investing. You can actually be sideways or negative for an extremely long time period. And I just have a really tough time doing that anymore. I'm getting older. My clients are getting older. Doesn't matter how good the company is. If it's going to have a 10 or a 15-year period where it's not profitable, that's too long. And when you're looking at individual stocks, they all have the propensity to do that. In fact, I was talking to a gentleman, a very nice guy, last night. We were talking a little bit about Boeing. And I remember early in my career when Boeing came out and the analysts were all happy about it. It was right around $75 a share, somewhere around there. When it dropped down to 65, the analyst is pounding the table saying, you got to buy this stock here. Yeah, when it dropped down to 55, it's even a better deal now. And at 45, he stopped talking about it. And at 35, I was going to wonder where he is now. And by the way, it took several years to recover, and it did finally recover. And in fact, it recovered, actually, as I left that firm to go to another firm. But at one point, it reached a price, $30.94 in 1990. And in 2009, it got down to 29. So that's 19 years. Anyway, I hear the music. I got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420. Stay tuned because I'll be right back. And we're back. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. You can also find me on the Fish's website, 955thefish.com, on their podcasts. And you can also get it on iHeart. And you can go to Bullington Capital. That's my website. It's www.bullingtoncapital.com. And you can actually find it there as well. So we are all over the place. And I think we might actually start doing some live broadcasting of the show, so when you call in with questions, you'll actually be an internet star. Yeah, I doubt it, but because I don't think the show will actually get picked up that much, but that's okay. Anyway, we were talking a little bit about the how to get guarantees from, or some of the guarantees that are being currently offered. By the way, the product that we're talking about is from Nationwide. If you want more information on it, just email me. I'll send you the PDF. It's already been compliance approved. Probably needs a little bit of explanation. There's a 7% simple interest roll-up rate. Simple interest means it's not compounding. So if you put $100,000 in there and you got 7% on it, it's $7,000 a year each year. So you're not getting the interest on this $7,000 from the prior year, but over a 10-year time period, $100,000 would be $170,000, and that is for a benefit, a rider. They're not guaranteeing that your cash is going to be worth that, because you can't do that. You're not allowed. What they're saying is that if you wanted to have an income from this at some point in time, they'll guarantee that the value that they use to calculate what the income is going to be is going to go up by 7%. Simple rate each year for as many as 10 years. So let's take an example. I'll just take an example. Let's say you're 55 and you got $100,000 to invest and you're looking for something. So you decided that, let's say you're 65. Let's do that, because that's actually the example that's in the PDF. You've got $100,000 and you want to invest it. If you took the income today, they would guarantee a withdrawal rate of 5.65%. Okay, that's if you took it today. If you waited, and by the way, 5.65% of $100,000 is $5,650 a year. If you waited for 10 years, it would be they would use the income benefit rider base. That's what they would base the number on, of $170,000. That's the $70,000 that they guaranteed for the income calculation. And because you're a little older, instead of giving you 5.65, they'll give you 5.85. That's $9,945. And as long as Nationwide remains in business in good standing, by the way, they are A+ rated, it's very strong currently financially. That's a pretty good deal. And adds a little bit of certainty. You're getting near retirement. And by the way, if you were just 5 years away or you're 2 years away, you still get the simple interest rate for those 2 years, and then you could convert it. And there is a table on this same informational piece. There's a table that shows what the interest rates are. I've got to tell you, these are not the highest rates that I've seen on annuity products, but the other products that I've seen that have had higher rates than this are putting your money, they're investing your money in the general fund of the insurance company. So if they had problems because, I don't know, they were heavily exposed to a lot of Florida housing and you got another hurricane or somewhere in Texas and the Gulf around there, and they had losses from that, and the losses got too big, or we had another collapse like 2008 and 2009, a lot of those companies had to go back to their policyholders or annuity holders and say, I'm sorry, we can't afford to pay what we said we could. Here's your offer. And they reduced sometimes the principal, most of the time the principal and the rates of return that they could generate. So you have that risk. And that's kind of with any insurance company, especially if they put the money in their general fund. One of the big key differences between this and those other types of products, those other types of annuities, is that the money's not in Nationwide's general fund. It's invested with Fidelity or T. Rowe Price, or whichever funds we choose, whichever funds I choose, I typically manage that money. That's who has the money. So it's not going to be affected by the hurricanes or the claims. If suddenly you've got a whole bunch of people dying, or a lot of car accidents, where you get a earthquake in California and a whole bunch of property damage gets done. That's not going to have any impact on the people that are investing in this type of annuity. That's kind of a big deal. It's actually kind of a really big deal. So if you're hearing stuff and you'd like to talk more about it, feel free. Just go to my website, reach out to us, or you can call us. The phone number's all over there, and I'll just give it to you now. It's 334-664-0700. That's 330-664-0700. This is kind of a big deal. I think you're going to be hard-pressed for people to make changes, or actually to keep up with the guarantees that are being offered. Just over the projected rates of the interest rates, of where interest rates are now. I mean, think about this for a second. Interest rates are typically under 2% for anything that comes with a government guarantee. And I just have to check really quickly to see what the Wall Street Journal's rates are on a 30-year bond, because I can't remember what that is. It's somewhere less than 3%, I think. And I'm going to click on my markets tab right now, and it's not giving me that. Oh well. Anyway, let's say it's less than 3%. So, actually, they're less than 2%. You get a 10-year Treasury bond. I think it was 1.78 or 1.8, somewhere around there. Anyway, it was less than 2%. So if you're going to get less than 2% on a bond, and you've got 40% of your money, that's your typical balance fund, like 30-40% in bonds, then that is that's not a real high rate. That's not a real high rate of return. So if you're getting, let's say you're getting 2%. 2% on 40% is 0.8. 0.8. So that 40% of your money you've got invested in treasuries or CDs, that's getting right around 2%. That's only going to be 0.8% on your total. That's all that's contributing. That's one of the reasons balance funds don't keep up with the stock market when the stock market's running real fast. And people go, oh, well, then just jump in the market when it's going real fast and get out. No, sorry. Trying to do that is certain death. The average investor who tries to do that has had an average annual rate of return of 1.7% over the past 20 years. 1.7. And they get, the bonus though, the good news is they get the frustration of watching them miss and then missing again. Let me get in and get out. And doing that is incredibly difficult. There used to be some things that had worked reasonably well. They stopped working about 6 years ago, actually 5 years ago. And unfortunately, when they stop working, you don't know that they've stopped working until you've been in it for 2 or 3 years after it stops working. And because oftentimes a lot of those techniques will take a hiatus, 2, 3, 4 years, and then they'll kick back in. Hasn't happened this time, and I think I know why. There are lots of reasons. The biggest reason is that the number of funds that are being run by computer today have swamped the actual funds that had been run by real people. So, and the computers are just hard math. They don't care. They're emotionless. When these other indicators tended to work a whole lot better, it was because there were a lot more humans involved, and humans are emotional. It's actually been kind of good for the market overall. And I think positioned the way we are now, this should really help us out in the future. However, you're still looking at those really low interest rates on bonds. And you've got 30 or 40% of your money in bonds, you're probably going to do somewhere around 25 to 30% less in total returns than the stock market. Why? Because bonds are not paying very much. And that really hurts people because they look at that and they go, wait, well, how come I'm not up as much as the stock market? Because you have money in bonds. Why do I have money in bonds? Because it's not safe to have 100% of your money in stocks. And that's a tough one. I have that conversation constantly with people. And they think that somebody should be able to jump in and jump out at the right times. If that were possible, everybody would have more money than Warren Buffett. He'd actually be willing to shine your shoes for a tip on stocks. Even at his age, 87. I think he's 87. But the good news is you don't need to do that. It's not necessary. You really don't need to do that, especially where we are right now. There's this thing. It's called an earnings yield. It's kind of converts a stock into something that's comparable to a bond or a CD. And all you do is you divide the earnings that the company's made over the past 12 months by the current share price, and it'll tell you what the earnings yield is. If the yield is a whole lot less than 4 or 5%, it's because the stock's overpriced. I just got the high sign. I only have 2 minutes, so I'm going to kind of hold off on explaining that, but I will pick it up right after the commercial breaks that we go to. But the earnings yield thing, that's kind of a big deal. And you can learn this one. This one's not that complicated. I will start to teach this at my future seminars, and feel free to call me up and go through it over the phone at some point in time. And I will write a little piece on it, and I guess I'll post it on my website. But I think this would probably help more people and help them avoid panicking. That's the number one thing, is avoiding panicking. Share prices fluctuate a lot. It's unpredictable. Don't worry about it. The only time you really need to worry about it is when you're holding on to shares that are overpriced. Now, a lot of funds that are out there will actually use the valuation as one of the tools to manage that fund. That's why they're so important. That's what I like about it. They're also one of the reasons that it's changed the way that stocks behave, because these guys put these funds together and said, hey, public's not doing that well. And a lot of mutual funds are not doing that well. We need to have a little bit more discipline. We need to put these products out here that are using values and numbers that are important, that have been proven to be important, that make sense. If I have a company that earned $1 a share or $5 a share, and it's selling for $100, $5 is 5% of 100. What did I say? Between 4 and 5%. Great, it's 5%. You're good. You just need to diversify now, because if those earnings get cut in half, guess what happens to the share price? Yep. If the earnings go up, share price goes up. Now all you have to do is have a crystal ball that will predict the earnings accurately. Not that easy to do. Hey, hear the music? That means I have to take a real quick commercial break. You're listening to Bill Bullington right here on 1420. Stay tuned. I will be right back.
There's angels holding on to both sides of the wire. I'm like what I need to carry you through it. Stay back or get on track, 'cause I can't have you ruin it. I say hold on, but don't hold me back. Hold on, but don't hold me back. Hold on, but don't hold me back. You just hold on. I had it rough, I had to move for a while. Locked down the house and chained up with the now. I'm coming home and everyone is invited singing. Don't bring that trouble with you. Don't bring that trouble with you.
Well, I thought that I had seen most everything, and if jaded was a people, I'd be the king.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. You can find this show also on the podcast at the Fish's website, 955thefish.com. Or you can find it on iHeartRadio. It's also there. Or just go to my website. We are trying to put ourselves all over the place. Anyway, just looking at the current rates on Treasury bonds. So they go from a low of 1.57 to a high of 2.24. And to get that 2.24 rate of interest, you got to hold on to the bond for 30 years. Oh, wow. 2.2. See, that's what I was talking about a little bit earlier. You don't have there's not a lot of safe income out there that's paying much. And when you're putting bonds in a portfolio to keep the risk down, you're naturally going to reduce the returns fairly significantly. And jumping in and out of the market, that's called market timing. That is a horrible idea. Everybody gets the idea that they should do that. And let me give you a little exercise that you can do that will cure you from ever wanting to do that again. Get a notebook and a pen. Every morning when you get up, write down what you think the market should do that day based on what you read or heard on the news the prior night. Or look at the news in the morning and just write it down. Do that for about 6 months. You will never do that again. It's just stocks are not predictable in the short run. They're just not. And I don't care what they say on Facebook, what those ads say, what the ads say when you do a Google search. They don't. And no matter how much money you pay for it. So I guess realistically, I know you're going to have to learn that lesson the hard way because that's how most people learn. It's the hard way. And I've always said experience is the best teacher, but I prefer it to be someone else's experience that I trust. That's a big deal. Someone's experience that you trust. Because if they're trying to sell something, I don't know. So we don't sell anything at Bullington Capital. We're advisors. We work for you. We don't work for the brokerage firms that we use as custodians. And that's another thing that's kind of interesting. We never have custody of your money. It's always at a huge brokerage firm, either Fidelity or E-Trade. And that's kind of a big deal. It keeps your money safer, a lot safer. So we're talking about safety and money here. So when you're looking at the highest rates that you got to hold, for government bonds, 30 years, to get a 2.2% interest rate on, not all that exciting. And I'm not even sure why one of the companies that I work with, I do a lot of work with, and they put out a lot of good research. They're talking about interest rates that they thought would be closer to 3. And I'm thinking, where on earth are you finding a AAA rated, government-backed security that's got a 3% interest rate? Because I can't find them anywhere, and I have the same access that they do. So I think they just didn't update the paperwork. And when the new paperwork comes out, it's probably going to be reflected in that. But anyway, so if you're looking at that, and again, why am I talking about this? Well, because it's a little upsetting for me to see people hurt themselves by looking at a pure stock fund, looking at the returns after it's had a good run and saying, yeah, that's what I want. And they project that out into the future as if it's going to repeat itself. Well, they rarely repeat when they've had a really good run. If they do, it's typically a few years between time periods where they actually do that. Normally, if you get one really good year out of every 4 or 5 years, you're doing pretty good. So to be loading up on something that's just done very well, not the best idea, because it may be another one of those 4 or 5 year time periods between the next big move. And that's just typically how stocks move. I'm not sure why. It's just the way that it's been working for the past 100 years or so. And it's enough to frustrate people, enough to make them think that they're not doing the right things. And it's tough. So if you're combining that method of picking funds along with keeping a big chunk of your money into bonds, you just won't make as much money. And that's why I think looking at the guaranteed rates that you might be able to get on as a rider, it's not on the money itself, but it's on the amount of income that you can receive and the account value that they will calculate that from. I think that's worth taking a look. It's absolutely worth taking a look. And I got to tell you, I don't really treasure utilizing these products too much because the paperwork is enormous. I mean, it's incredible. It takes about 45 minutes to fill out an application, and that's because I'm fast. Actually, Melissa's faster than I am, and she can probably get it done in 20. But because she is super fast, and Melissa's the head admin for our firm there, little firm at Bullington Capital. Very good. Gary's also very good. And Brad's very good. So I'm lucky that way. But I'm telling you, it's a lot of effort. And we don't get any extra pay for that either, by the way. So I'm just looking out, and I think this is very attractive. If you want a little bit more stability, I think you need to take a really good hard look at some of these things. When you're looking at them, there are tons of products out there that sound similar. Most of them are extremely confusing. You just have to be careful. If it's not a variable index, well, not an index. I stay away from the index. Whenever you hear the word index, I would probably really slow down, because those things have big penalties if you take money out. They'll tell you, oh, you can take 10% out a year without penalty. Yeah, but what happens if you need more than that? How much you're going to have then? And if you hear the word market value adjustment, don't walk away from that one. Run. Those market value adjustments are incredibly difficult to calculate. And insurance companies will tell you that they can't. They can't calculate it because they don't know what it's going to be. And I get it. It's the way that the portfolios are hedged and set up. It is impossible for them to know ahead of time what it's going to be. So you could have a market value adjustment on top of a penalty. Just be very careful. I mean, they're not all bad. Not all of them. But some of them are just abusive, and that's one of the reasons we got the Department of Labor getting involved in writing up all these rules and coming up with a 40-page application for the good guys. They miss the bad guys, and they're trying. I mean, and realistically, at some point in time, and I know people hate the idea of having larger government, but if a candidate comes out that says, look, we're going to have, just like we have the FDIC, just like we have the SEC and FINRA, we're going to have a national insurance commission. So to take some of the relief off of all these state agencies. And by the way, just hire everybody that works for the state and train them on one set of rules. Why would you have 50 different sets of rules for the same products? And you know how difficult that is? So anyway, I would be all for starting up this department because we need it. It's actually needed so that they can unify all the rules for all the states. And you've got governing bodies. You already have the bunch of the employees. You wouldn't have to add a lot of employees. But this is important because a lot of people are taking IRAs and 401ks and rolling them over into a lot of these products that are just so heavily fraught with expenses that people can't make much money. Anyway, so I'll get off my soapbox and I'll start to talk a little bit about Look Out for the Bull. That's the other business. That's the educational / tip sheet business. I'm actually going to call it a tip sheet because here's what I've been doing. I've been taking the scans, and the scans, when I run all the scans that I run, they're typically somewhere between 80 and 90 stocks. It doesn't take me that long to whittle that list down to, say, 20 or so. 20 stocks that are exhibiting characteristics that are typically present in other stocks that have done very well in a relatively short time period. Notice I say have occasionally done well. And that's part of the whole process. If I knew exactly which ones were going to go, I wouldn't be doing a radio program talking about it. I'd be flying over in my fleet of personal jets. The Warren Buffett would be asking me for tips. But you can manage the risk, and it's fun. And I like making money. It's a hobby that you can actually make money with. So that's what I treat it like. I don't put a tremendous amount of my money in there, neither should you. And if you want to do it, I think it's $20 a month, no long-term commitments. You get to see what my thoughts are. I talk about them on a radio show quite a bit. In fact, you know what I'm going to do? I'll run one of them while I'm here and in the studio. I'm going to run it right now during the day. First thing I have to do is pull up the list that I'm going to be screening for, and it's the U.S. common stocks. That's all the stocks that are in the United States. I'm looking for those that have done the best over the past 90 days. That's one of the scans that I use. And so over the last 90 days, I want to see every stock that's trading at a 30-day high. I mean, that's just 30 trading days is actually 6 weeks. And right now, there are, let me see, there are only 19 of them, but that's because it's kind of early in the day, and it's a Friday. So if I go down that list, the first one that comes up is Tribune Publishing Corporation, the Tribune, in newspaper. So I'm not real enthused about a newspaper because I don't know what their growth is. I think at some point in time they probably go away. So I want to take that one and go, I don't know. I'll probably pass. And Cato, consumer cyclical sector. These are apparel stores. Its price to sales ratio is 0.41. It's got a decent looking chart. We're coming up on the Christmas season. Probably 0.41 is low for the industry. So I'm going to flag that to go back and take a look at it a little bit later. The chart pattern looks interesting to me. Yeah, then I go to Select Medical Holdings. This one's been showing up quite a few times. This is a publicly traded hospital system. That's really wild. By the way, I know somebody very well that works for that company, and it's interesting. They've got hospitals all over the United States. Quite frankly, it's got a very low price to sales ratio. This stock has been moving up really fast over a fairly short time period. So I would say, yeah, that one's okay. That one's okay. If you wanted to take a shot at it, you go to read the 1% rule on the Lookout for the Bull website to figure out how much you should put into it and where to place your trailing stops. And I'm going to go down, keep going down the list. Grief Brothers, these guys are supposedly packaging containers. That's kind of an old economy. I don't know. Not all that fond of that. America's Car-Mart comes up. It's got a nice looking chart, super volatile. But there's the profit margins in that type of business are extremely low, so I'm probably going to pass on that one. And here's one I like just based on this is an industrial stock. It hasn't even been public that long, since 2015. It's called SPX Flow, and its symbol is Flow, F-L-O-W. Industrial sector, diversified industrials. I'm just assuming that it probably has something to do. I don't even know. I'll have to look this up. But I'm assuming that it has something to do with sewers or plumbing, and probably makes parts for that. So I'll go look that one up. I'm going to flag that one and come back to it later. And this is kind of the process that I'm going through every day, and then I'm publishing this stuff. And these are the same things that I'm buying my stocks from. Here's the one called Buckle. You might recognize Buckle. They have some of their own stores. They make belts, wallets, that kind of thing. Price to sales ratio is not bad. Stock's up 17% today. So when it came up on my list 3 weeks ago and then came down almost immediately, if you had purchased that on the open, which is what I typically recommend, you wouldn't have gotten stopped out. Woohoo, sweet. So now you'd be up about 17% or so. And but that first week that you bought it, as soon as you bought it, I mean, it went down for nearly 2 weeks in a row, went down about 10%. And then today it's up 17% in a day. That's just kind of how this stuff goes. And I'm glad to be able to tell this. I'm going to go down the list a little bit more quickly because I just have been told that I've only got a few minutes. There's the Stars Group has a nice looking chart. This is a consumer cyclical. They're calling it consumer cyclical. It's a gambling organization. I'm not a really big fan of that, so I'll probably pass on that. Nuance. These guys make software that converts language into text or so that you can speak to your computers. And I like that idea. Price to sales ratio 2.42. That's not too high for a software company. It's got a nice looking chart. So if I'd probably take a shot at that one. And I think I'm coming up to just where I'm almost running out of time here. So I'll do this every week for at least 15 minutes at the end of my show. Give you some individual stock ideas, and go to the website, Look Out for the Bull. Make sure you read that 1% rule before you invest in this. And anyway, I hear the music, so I got to take off. Have a good week, everybody. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420, and also available on 955 The Fish as a podcast. Thank you very much.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.